I want to talk about the drawbacks, the disadvantages, the pitfalls inherent in growth investing. Growth investing actually has to do with an investor buying the shares of a company that is growing at an above average rate. This strategy has its own drawback, and I want to highlight these drawback in this content. Number one, high volatility. Growth stocks are known to be volatile. They tend to fluctuate a lot. And as they fluctuate, that particular volatility may affect the investor negatively. And so, as a growth investor, you should be ready to withstand, to tolerate, to bear, or to endure volatility in the market. Unlike other classes of stocks that are a bit resilient to volatility, growth stock shows and a higher than average level of volatility in the market. Number two, overvaluation risk. Overvaluation risk. Growth stocks may be overvalued in the long term. As these stocks continue to grow and grow as a result of investors piling into the stock, buying the shares of the stock, it tends to compel the price to go higher. These prices are not expected to grow to the sky. Eventually, it will get to a point where it is considered overvalued. So once you are holding an overvalued stocks, it's expected that all things being equal, the stock will eventually correct. Market correction will set in, and that will then result in your stock going down, and invariably it will result in losses in the portfolio. And so that overvaluation risk is inherent in growth investing. Number three, no dividends. Growth stocks, unfortunately, are not known to be dividend aristocrats. They don't pay dividends regularly. Sometimes they don't even pay dividends at all. What they do is that they plow back their earnings, they plow back their profit into the company to keep on fueling further growth in the company performance and stock price. And so they don't tend to pay dividends compared to other stocks in the market. There's that particular risk of you not having a stream of income that other investors are having as a result of their stocks paying dividends. It's a drawback you should learn to live with as a growth investor. You shouldn't expect dividends like other investors are expecting. Number four, market sensitivity. A typical growth stock is sensitive to the market because growth is generally influenced or are conditioned by sentiments in the markets, by investor behavior in the markets, and other externalities of that nature. And so a typical growth stock is sensitive to the market environment, it is sensitive to the economic performance. If the economy is doing very well, growth stocks will tend to perform very well. And if the economy nosedives, that will affect the rate of growth of stocks in a typical growth portfolio. Number five, high expectation. Companies that are in this particular class, growth companies, attract high expectation from investors. Investors believe that a growth stock will continue to perform very well in the future, to keep on growing and growing almost without a limit, a sky limit. It doesn't happen like that. Eventually, the stock will tend to correct, might tend to go down, might lose momentum. And in this particular condition, the investor would end up losing his hard-earned capital. It's a very important drawback an investor must bear in mind before embarking on growth investing. Number six, increased risk. Growth companies generally are companies who are newly enlisting in the market. They are new companies, they are fresh companies, they are like startups that are not tried and tested. They are not mature, they are not fully established. And so a growth investor will need to accommodate this risk, will need to take this particular risk into consideration. And generally speaking, growth stocks are quite risky compared to other stocks in the market. Number 7, longer time horizon. Longer term horizon. When we talk about growth investing, the growth we are expecting, is a long-term affairs. The growth may not materialize in a few weeks or in a few months. It might take months and sometimes years to materialize. And it will take people who have a long-term horizon to adopt comfortably this strategy in the market. And so if you are thinking short-term, if you are short-term oriented, then growth stocks are not for you. But if you have that long-term horizon in mind as an investor, then of course you can adopt growth investing. Number 8, emotional stress. As I indicated earlier, growth stocks tends to fluctuate at an above average rate. They fluctuate, at a higher degree. The price swing is at a higher degree, and they respond so positively to trends in the market environment. And this level of fluctuation will induce a high level of stress in the investors concerned. And so you should be willing to bear the stress involved. If you don't have the capacity to bear the stress involved, then I wouldn't expect you invest in growth stocks. But if you are emotionally stable, you can bear the stress of seeing your stocks gyrating like a pendulum, then of course growth investing is for you. If not, I will advise you try other investment strategies like value investing. Please subscribe to this channel and press the notification button. Don't forget to give me a thumbs up and share this video. It will go a long way in helping me, keeping me motivated to keep on providing you with this level of enlightenment as a beginning stock investor or even as an experienced investor in stock. Number 9, dependence on market trend. Growth investing is dependent on the prevailing trends in the markets, because when it comes to growth of stocks in the market, these growths are essentially influenced by market trends, by market sentiments. If investors believe that a stock will do very well in the future, they pile into the stock and will generate growth in stock price. And if they feel the growth may not take place as expected, then they pile out of the markets and then the stock will go down. So growth essentially is more or less influenced by market sentiment, influenced by expectation. Sometimes a company may not even have positive earnings, but the company will keep on growing. Why is it growing without earnings? It's because of what? Because of investor sentiment, investor expectation that the company will do well in the future. And so growth is dependent on investor sentiment, is dependent on the trend in the markets. That is what influences growth. It may not really depend so much on market, on company fundamentals. Sometimes it's simply based on investors' expectation. Number 10, potential for poor returns. Potential for poor returns or poor results. If you are investing in a growth stock, there's that potential, there's that tendency that the stock may not meet up with investor expectation. If investors expect that the company will grow, will perform very well in the future, and that expectation is not met, then they will tend to sell the stocks, and then they sell en masse. it will drag the stock price lower. And as the stock price goes lower, you end up, having a negative return or a poor result as an investor. So you consider all these risks before you choose growth investing as a strategy. If you are able to bear them, then I will encourage you to go ahead. If you cannot bear them, I will advise you look for an alternative strategy.